Okay. Let's get a closer look at the U.S. market in the wake of the latest Fed decision. We're joined by Quincy Krosby, Chief Global Strategist at LPL Financial. Quincy, great to see you.
Thank you so much indeed.
If you had to characterize Mr. Powell and his colleagues today, were they hawkish? Were they trying to reassure investors they're in no great hurry to raise rates again?
I think it was a combination of both, but I would have to say that it was a sort of a patient hawkish commentary, because two more members of the Federal Open Market Committee, from 5 to 7 from the last meeting, actually projected perhaps the need for another rate hike. But that said, he was calm, he delivered and answered the questions, but he made it very, very clear that the Fed is not going to abandon their mandate for price stability. He even invoked a visit, or a reporter actually asked him about a visit to a town in Pennsylvania. And he broadened out his commentary about how the need for the American people to have price stability is so crucial. That was clear.
That's interesting that he was trying to bring it to Main Street, as the cliche goes, saying it's not just a thing for financial markets. There seem to be, as far as I can see, Washington is not radically slowing its pace of bond issues, but it is moderating it a bit. Did that news have a big impact today?
Yes, it did. The market had been expecting, first of all, a larger amount of need for the Fed to the Treasury Department to raise money. In fact, they did actually lower the initial projections because they said tax revenues had picked up, for example, in California. But overall, it also looked as if the Treasury Department, very much concerned about these rates rising, are managing expectations. I don't want to say that they are adjusting the auctions, but it's very clear that there will be, toward the end of the fiscal quarter, there will be short duration notes coming out. That's been very successful. What we're going to see now are the 10s and the 30-year. That's going to be important for the market to see who's coming in to buy, because central banks, who are usually quite, how shall I say, not very price sensitive, they've been easing away, but not the private sector. So this is going to be interesting, but you're quite right. Expectations have been coming down. The Treasury is managing it much more. They don't want to see these yields skyrocketing.
I'm not sure if this is something you track, but apparently China, traditionally a big buyer of U.S. Treasury bonds, has been backing away lately.
Yes, we do follow it. China at one point held $1.3 trillion worth of treasuries. Wow. They moved away. They moved away some time ago, actually, as they're transitioning away from the U.S. and U.S. dollar. As you know, they've been a big buyer of gold, but overall they're down below $800 billion in the market. Japan is the largest foreign holder of U.S. treasuries, and for hedging reasons, the expensive hedging, they too have moved away. And now, if they lift yield curve control, their yields are going to go up. And the fear in the market is that you'll see a reallocation back to Japan once their yields are more attractive. So there's a lot riding on events globally, but also how the Treasury handles these auctions for the U.S. 10-year Treasury yield.
Maybe we could put up a one-year chart for the S&P 500, because you say it has managed to get above an important level, 4,200. What's the significance of that?
You know, we always look at, you don't have to be a technical analyst, but even the fundamental analysts, we look at the 200-day moving average. There's an old saying that nothing good happens when the 200-day moving average falls below, the market falls below the 200-day moving average, which is what happened to the S&P 500. 4,250. It's climbing back. It looks like it wants to move back. We always look at this to see whether or not volume is picking up in the market because, we've had some good breath. We've had the market move over, but you need that volume. And I hate to say this, the fear of missing out to come back into the market to move it up and move it above that level to give you some comfort that there's interest in the market.